with that, again, Saf, I know you don't have slides, but I'm gonna jump ahead to your bio slide. But why don't you just, again, I'm asking
Sure.
all speakers to speak less about yourselves and your companies, your funds. Just how are you seeing this market today? And then we'll switch back to how how I'm sure your strategies are part of your positive outlooks. But let's start with you, Safa.
Sure, happy to, Mark. Thanks. It's good to be here. I've recently been part of the 361 firm meetings, and I've really been enjoying it. So great to be here. Just very briefly, I'm Safa Rashji. I manage an early stage venture firm here in Palo Alto in Silicon Valley, and we're right now raising our second fund, which is a $30 million fund. But as Mark said, one of the things that distinguishes our strategy is that we like to look at the bigger picture, identify the macro trends, and then bring it down to investable trends. This is what I did when I was on Wall Street, and that's what Mark was referring to when I looked at China as the next big internet boom market that nobody was paying attention to. And that's what I kind of carried on. So within this context, we've been looking at what's been happening. And I don't mean just since February 24 when the war happened, or even since COVID started, but over the past few years, there have been certain trends that I would say maybe started back in 2019 or so, when WeWorks went under and people realized that you can't just buy growth by throwing $100 million from SoftBank and build up companies. To me, the last 20 years have been the era of disruption. And what we have started in the past few years is what I'm calling the era of reversion. Disruption was great, especially in the US. We're really good at doing this. We go in very quickly, very fast, with high speed. We build new things and it grows. But sometimes, as in 2000, as in 2008, we go so fast that we hit a wall and we have to come back. I think we're seeing a similar trend right now. And let me kind of explain a little bit by what I mean. So if you look at what's been happening with the trifecta of COVID, the war, the Chinese, in fact, maybe 4 factors, and now inflation and the high interest rates, I think everyone would agree that what we are going to have in the next 5 to 10 years, at least the next few years, would be high cost of goods and labor, unreliable and tight supply chain, high cost of capital, and volatile energy supplies and geopolitical risks. If you think about it, these were exactly the reverse of what we had in the past 20 years. We had cheap capital, supply chain was working like a charm, we had just-in-time inventory, and cost of capital was low. Somebody was referring to about, I think Mark, you said if we can invest in cheaply enough, we can make money. We calculated that the interest rates that we use, or people use for this kind of cash flow model, is probably going to be up by 5% based on the increases in interest rates and based on increase in the hurdle rate above the safe rate. So if you add that 5%, if somebody was valuing Tesla with a risk of 10% capital cost of capital, they're going to have to do it with 15%. That's going to be a fundamental change in valuation, and it's not just a one-year effect. This will continue because I don't think that we will get back to the low interest rates anytime soon. So based on these factors, what I think is going to happen is that we are going to see a situation where we will have investments move to infrastructure and productivity tools and away from what we had in social media, crypto, metaverse, and all that. In other words, we really need the next Tesla. We don't need the next TikTok. Second, long-term strategies will take over what is called FOMO, fear of missing out, and everybody has that, by the way. Even we have it here, and certainly in Silicon Valley. I mean, you see the most conservative firms jumping on things like crypto and others because they say, well, maybe there is something in there and we'll miss out. Just an anecdote, and this is really because I respect Mark Andreessen, but to see how even smart money jumps on this. A few years ago, there was an app that came out, and the only thing this app did was send you a beep saying Bing, that's me, nothing else. There was nothing else involved in it. And everybody was kind of scratching their heads, and they raised like $20-30 million. And Mark Andreessen came and said, no, we can't really dismiss it. There may be something in it. There was really nothing in it. So we all are living in an era where it's highly competitive, especially here in Silicon Valley. And we do build our models based on forma. I think that's going to change to longer term strategies. Third, labor costs will be increasing. We haven't really seen that yet. I know people have been talking about, but I think there is a change in the whole movement from capital to labor in terms of the advantages. And of course, we will also have higher regulatory cost environments, both here and especially in Europe, and these will change the cost structure for companies. And capital markets will begin what I would call a multi-decade rotation into risk assessment based on these higher interest rates and in inflation-prone economies. We have had basically deflationary. We were trying to fight deflation, and now we won't have that problem anymore. And I think this is, again, a multi-decade process that will take some time. And finally, I think asset allocations will shift a little bit more towards fixed income, real estate, and low risk sectors. Now, what I just listed here, these 5 items, aren't going to completely change things overnight. These are going to be gradual changes, which in my view will shift the pendulum that has swung way too much in the disruption side. We can bring it back, and that's why we're calling it a reversion. So I'll finish up soon, Mark. I don't know how much time I have, but I just wanted to list a few areas that kind of we distill this to, okay, if this is a picture of the reversion.
So you could just take another 60 seconds and then we're going to switch.
Okay, yeah. So what are the areas we will invest in within this? Well, manufacturing, logistics, commodities production. Second, defense industry, including cybersecurity, drone, and even space. Third, education models that increase access on a broad base, even vocational and non-academic skills. These are building infrastructure that we need. Healthcare access and optimization through expansion of digital health models, drug discoveries, and intervention for healthy living. Financial and digital inclusion models to bring in lower income and disadvantaged people into the fold. And finally, one of my favorites is optimizing smaller businesses, various industries, restaurants, manufacturing, farms, and all those things. So there's a lot to be done out there, this rebuilding that we need to do. Back in 2020, Mark Andreessen again wrote a paper called It's Time to Build at the time of COVID. It got a lot of attention and it was great. The problem is that if you go and read that paper, and I encourage you to do it, he doesn't say what to build. Everybody was confused. This is what I think we should be building. So let me stop there and just see if there are any thoughts or feedbacks on this.
So any quick questions, comments on what Safa just set out?
Safa, I'm glad you ended with an uptick, because I was getting a little bit on the depressed side, candidly. So I'm hearing you say infrastructure, cyber and defense, education for access, healthcare access and optimization, financial and digital inclusion, and small business optimization. Yep.
Totally. Yeah. I'm not saying there won't be anything in metaverse. I'm not saying there won't be anything in blockchain, but I'm saying this is what we got to build, because we need to rebuild our society. We need to rebuild our infrastructure. So let's focus on this, and there'll be opportunities to do other things as well.
Yeah, I mean, it could be that blockchain underpins some of those things.
Dan, I'm going to give you the stage in a second. Let's let Rob, our friend Rob.
Thanks, Mark. Hi, Safa. This is Rob Colorina. Just a quick question. Your thoughts are really driven, as you say, from Silicon Valley. Are you seeing more pairing and with Silicon Valley and other capital regions, or do you think your opinions, prevail to other capital regions?
Rob, what I see here in Silicon Valley is, to just slightly exaggerated, is most VCs are running around like chickens with their head cut. They don't know. They're panicked. I mean, I see people every day saying to the entrepreneurs, "Don't raise money. Things are going to get worse." What they're seeing right now is that we haven't seen the actual slowdown. It's going to be really bad. And in fact, going back to what was being talked about being positive, I do think that things are not really nearly as bad as people have panicked to, because the VCs here have been investing with high valuations, and now they're panicking and saying, okay, there's going to be a major reset. I think there would be a reset, but not as big. So I don't think my views are really that common here in Silicon Valley.
So good. We'll have a breakout for Safa. You can, and we'll have our, and Vadim, can you be like 10 seconds with your question? I'm trying to keep it on track. If you don't come on in 5.
I have no question. I'm sorry. I have no question. Withdrawn.
Okay, I didn't mean to be that strict, but I have to be. All right, well, look, let's move on to Ann Mooney. I want you to, if you, as you set the stage, just introduce yourself, and because I think, you know, what you do in finding deal flow opportunities, early stage, better valuations than you'd have in Silicon Valley, and then ushering them, chaperoning them to their next steps and maybe even exits, is always got a winning strategy. So, and we're happy to be, and truth be told, we're all associated with you, and that, you know, we're linked to you. So with 361 Ohio Tech, but if you could set the stage, and then we'll let you moderate because you're really good at it.
Terrific. Thanks, Mark. So as Mark indicates in the agenda here, so Ann Mooney, most of you know me. One of the things that I do is I'm a member of the Queen City Angels, a fund and group. We're a group of now 170 plus members. And I think what Mark alludes to, and I have found really impressive in the 6 years that I've been involved with QCA, is the level of rigor and structure that goes into analyzing the deal flow that we have. So we also have a very good source of deal flow that comes primarily from the Midwest. The current portfolio company for the Fund 6 that we are on right now, which is in total $23 million with Ohio's Third Frontier investment, non-dilutive investment. We've got about 35 portfolio companies right now, and we're projecting pretty strong returns associated with that set of portfolio companies. So it's a great group of folks that come from, successfully exited entrepreneurs, corporate executives, subject matter experts, and a whole wide range of things, where we're investing in things from med tech to ag tech to martech, and things of that nature. HR tech. I'm thinking about the portfolio companies right now.
Sure.
So thrilled to be here. Think that there's a lot of great value in the Midwest, great ideas, incredible entrepreneurs, and additionally, just a lower cost of living for folks. So to start a company and grow a company, I think uniquely that Ohio and the Midwest is a great place to do that.
So now turn your moderator hat on.
Okay. All right. So I've got an esteemed panel here. Thank you, Neil Gupta, Barry Adams, and Hamlet Yusuf for joining. So as you think about the shifting landscape that we're living in right now, and what Stephen Burke just outlined, thankfully it's not RIP as it was a few weeks ago, but it's continuing in that direction. With the shifting of the market, how do you see it shifting further, firstly, and what strategies make sense for you in today's market?
I'll kick us off if you guys want. This is Hamlet Yusuf. Great question. And I'm going to echo some of the things that Safa talked about. For those of you guys who've heard me speak prior, my background comes from the national security defense arena. We run a hybrid VC focused on emerging technologies and national security. Have been following the Ukraine crisis, obviously very closely in terms of what's been happening there. Been a little contrarian in terms of what this really means and whether Putin is winning or losing. We're of the opinion that obviously there's gonna be a lot of disruptions coming out of this. This is a beginning of, I think, a much greater conflict that's going to be shaping and reshaping geopolitics. What does that mean from an allocator standpoint? One of the things that I think Safa talked about was investing in venture. The the natural inclination has been to run for the doors with all asset classes. But we actually think that if you are allocating into specific niche markets where you're actually creating technologies, where you're actually creating companies that have a longer term horizon, meaning the company's not even going to be at revenue for another 12, 18, 24 months because they're building a platform or a foundation that's going to pursue primarily government or defense or larger scale enterprise revenues, that's actually probably a safer place to be. If you're trying to chase the next delivery app or the next dating app or the next social app, good luck. Crypto and everything that's happening there with the metaverse, good luck. It's gonna be a frothy market, but there are gonna be opportunities to hide out here. And I think, frankly, in terms of if you look at how the economy is shaping up, you want to be putting money to work in areas where you're actually creating companies, because when you invest in two guys in a garage or a team of entrepreneurs working out of an accelerator, as they grow up, that team is creating a product, that team is creating a company, that team is creating an industry. As a company grows, it goes from 3 people to 15 and 20 to 30 people. That's tax revenues that's being generated. They're creating a company, they're creating jobs, and that's, I think, what's going to help us longer term from an economic standpoint. So that's kind of our general view, not getting into the geopolitics. Just if you look at it from a macro standpoint, that's kind of our view, especially as it relates to early stage venture.
Terrific. Neil, Barry?
Let Neil go. And I think Mark wants to take Barry's place, Ann, but Neil, why don't you?
Oh, okay, terrific.
Yeah, thanks, Mark and Ann. Yeah, I mean, I totally agree with Hamlet. If you look at a lot of learnings from the 2008, 2009 recession, we had major tech companies born out of that recession. Uber, Spotify, Airbnb, Square, they were all founded during that recession. So the pace of innovation, we feel as early stage investors, we feel that the pace of innovation actually accelerates during a recession. And there could be various reasons for that. People are, out of jobs or looking for, they're cutting their costs. And also they really know how to tighten the belt. Sequoia had a 52-page white paper out to their portfolio companies and in general, the startup community, talking about the downturn and, belt tightening and, there's going to be less access to capital. So startups actually become very efficient during recessions. So, I mean, I'm not saying it's a great thing, but, the last 10 years have been a real boom time. It's been a bull run for startups and tech in general, as we all know. And it could be that there's a correction coming, or have some of it's already come, particularly in later stage startups. We're seeing our startups, which are a little more mature, their valuations are being, they're getting quite a haircut on their valuation. One NFT company was going out at 200 million valuation, and they had to slash it to 100 million to get investor interest. Whereas the early stage startups are not having as difficult a time in terms of valuations, but they're having more difficult time, obviously, raising money. People are looking for more revenue. 40% of startups are really in the red zone regarding cash, meaning they have 3 months or fewer of runway. So there is definitely danger of a lot of them going out of business, and maybe only the best ones survive, or the best ones who can raise capital. Sometimes it's a matter of who's best at raising capital that survives. So we're seeing a lot of opportunity, honestly, from where we sit. We help our portfolio companies in various ways to succeed, and we think investors who are really involved with a portfolio have a better chance of positive outcomes. They're obviously Web 3.0. I don't think that's going to slow down. Huge opportunities there. I wasn't a huge believer in metaverse, but when you're talking about blockchain and IoT and AR, I'm not a big believer in crypto, frankly, but if you look at the services and products around these areas, blockchain, then there's a lot of opportunity. metaverse itself is expected to grow from 62 billion this year to 427 billion in 2027, which is just 5 years out. You know, and that's being fueled by all these adjacent technologies. Like I said, blockchain, IoT, AR, VR, 5G, gaming, hardware, media entertainment, and it's affecting industries in a really big way. You know, retail, you know, they're doing a lot of gamification, world, you know, virtual simulators, using metaverse. Education, which is a huge, obviously, issue globally. Metaverse is allowing, if you talk about the hybrid learning model, it's actually helping the, you know, students rather than hurting them. Even, I mean, during the pandemic, we discovered that although it was obviously a lot of pain, but I think the outcome, long-term prognosis is pretty good in terms of education and the hybrid learning model. Healthcare as well is metaverse is
Neil, I know that you've got 500, almost 550 portfolio companies. You hit a lot. You're a bit of a proxy for the venture world.
Yeah.
I think it'd be good if I know Barry's not able to make it. It's really too bad. He's but his partner, Mark White.
Yeah, Mark, let's hear from you, Mark. That'd be great. And Neil, thank you. There's so much great perspective that you have.
Thanks.
Yeah, that was terrific perspective, Neil, and thank you, Ann. Yeah, my name is Mark White. A lot of you know me as a managing partner of Prairie Crest Capital. We were founded in Des Moines, Iowa about 5 years ago, mostly focusing on ag tech. We've evolved in preparing for a raise on a new fund in the fall, which we've got the backing of 2 family offices currently, but we'll be raising more LP dollars. But we've evolved to focusing on deep tech and ag tech, deep tech and science tech. And so our view is a little bit siloed, and we've traditionally focused on the middle of the country as well. So we've got those 2 layers. But most of our focus going forward will be on innovations coming out of research labs and academic institutions, which is where we had most of our success in ag tech. So, you know, I read a lot, and you know, if you get on, you know, the venture Twitter, and you hear a lot about the changing valuations and how people are struggling raising cash. You know, we're very early stage. So I echo what Neil said, that an early stage is not that much affected now, but any early stage company needs to raise additional rounds of capital, particularly when you're talking in science tech. Those rounds of capital have to do with building things. And, you know, Neil had mentioned also that, you know, the future is building things, and that's really where we're focused. But we're not seeing much trouble with the firms we've invested in raising their next round of capital. We've not seen many challenges on valuations, because those valuations were always challenged, because you have to build a facility, you need property, plant, and equipment, and things like that. So those are always challenging areas from a valuation perspective in the venture world. So we've not seen, so there are some unconventional financing structures that are put in place, and unconventional venture investors. So we're not seeing any change in that marketplace right now. And part of it, I think, is because we start out very disciplined on valuations. From pre-seed, before the company has revenue, it's still an idea, it's a scientific discovery, all the way through each subsequent round. We're very disciplined on value, venture capital, enterprise valuation. So we're projecting out, you know, 7 to 10 years in advance. Every round of financing we do, every time we mark to market the companies, we're looking at the real returns of the company over a 10-year period, and we always discount that by about 10 to 12%. Not only is it discounted by 10 to 12%, we do a risk discount on that by about 50%, and we just make sure that it makes sense from, you know, a risk-adjusted valuation standpoint. So in our market, we're not seeing a lot of changes, but I anticipate if we have some additional economic turmoil and some pullback on allocations in venture, we may experience that down the line.
Mark, that's great perspective. You know, interestingly, and perhaps not surprisingly, at QCA, we do a similar thing with our valuations. The time horizon isn't 10 years, but it's at least 5 years. And what we do is we take the founders' projections, and then we risk discount them by 50%. And we look at what the IRR is in each of those scenarios, saying, hey, any set of projections that's put forth is never going to come true, right? Plus or minus. And we definitely do the same thing on the discounting. It's interesting that you have an even longer time horizon that you look at in 10 years as well. So this is great. Mark, anything to add before I transition?
I think we should go back through, and I think everybody talked about how they saw the market, maybe how they saw some of the winning themes or approaches. Maybe they, well, actually, we have enough time. We can get questions from the group. So these are more like fund platforms, angel platforms. You've heard in one second, one's very focused. Actually, you two are industry focused. Neil is an omnivore.
Yep.
Of sorts. He likes the best vegetables, the best fruits, but that said, any questions from the group, from our community?
Mark, I'll add one thing here. When it comes to investment themes, the other thing I think people are starting to realize, and this is a trend that began pre-COVID, and I think COVID significantly accelerated, was venture was always Boston, Silicon Valley, maybe New York, a little bit of Austin, and that's about it. Nowhere else really mattered. But that, I think, significantly changed. That trend began probably about 5-6 years ago. We were actually at an event in Silicon Valley with Peter Thiel, and he was talking about 50% of every venture dollar in Silicon Valley isn't going to a startup. It's going to landlords, slumlords, and commercial real estate because of just simple cost of living in Silicon Valley. And what Silicon Valley was not realizing was that a lot of the technologies that they were creating were actually going to enable people no longer to be in Silicon Valley. So as an allocator ourselves, a lot of the funds that we invest in and a lot of the portfolio companies that we invest in at the early stage tend not to be in Silicon Valley. I'm perfectly happy for those companies to go to Silicon Valley to get a nice outsized exit. But at the startup level, if I'm investing in an AI company and there's a comparable team in Silicon Valley that's doing the same team, chances are if I'm investing in Cincinnati or Florida or Atlanta or somewhere in the Midwest with the flyover states, that company's valuation is going to be probably a fraction of what it is if it's a Silicon Valley company. So I think there's a lot of value there. I think team selection becomes critical. And also going back to the whole conversation around niches, there's two things I think for early stage venture to be successful, you need to prove out. One, you need to be able to prove out you have true access to proprietary IP or deal flow. So whether it's coming out of a research center, whether it's coming out of an incubator, or whether it's coming out of the ecosystem, understanding where that true IP is coming from and being able to vet it is one piece of it. Two, like I said earlier, I think the asset classes, especially in early stage venture, that are going to do well are the ones that are pursuing longer term sticky revenue opportunities, large scale enterprise, government, defense tech, space. Those are all key areas. So if you can show as a VC, you have a good understanding, good pulse of what that ecosystem is looking for and what the demands of the decision makers are going to be, being able to invest and then bridge that relationship into or in front of the right customer, I think is going to be critical. Regardless of how bad or how choppy or how frothy we think the next 6 months to 2 years are going to look like, there's one dynamic that's not going to change. Entrepreneurs and startups, because of the issues we're having in the workforce, are still going to be there. They're still going to look for ideas. They're still looking to create, and they're still looking for capital. And if you're an allocator and you're a family office, yeah, you're going to pay attention to what's happening with commodities and the S&P and whatnot, but you still have a balance sheet you need to allocate. So as an allocator, you're still looking for allocation opportunities that are going to provide real risk-adjusted returns with some protection in terms of what's happening both geopolitically and economically. And I do think that, again, investing in niche strategies, niche managers, niche funds at the early stage, investing in technology that matters and actually builds longer-term industries is actually a good place to hide out and be over the next 2 years.
Yeah, I'd agree with that, Hamlet. Those are excellent comments. And as far as themes, we're more focused on where the research is coming from and what the needs are out there. So, we're focused on energy, food, health, materials tech. Materials is really a underrated sector because we make most things out of plastic today, and that has all kinds of ramifications, including on refinery capacity, right? We're focused on those areas, and then cybersecurity and AI in the deep tech arena, because we're going to need a lot of technologies that really enhance productivity going forward. And so cybersecurity is an obvious one, why it's there, but the AI application to productivity enhancing technologies, I think, is a really underrated area, particularly when you deal in areas like food production.
You talk 30 seconds on Michigan, since you're helping us put the Michigan event together. We're going to talk about innovation in Ann Arbor. We're going to try to help the world in Grand Rapids.
Yeah, one of the areas that we're particularly focused on is the difficulty of pulling research out of research labs and the commercialization. There have been a lot of papers written about it recently, how much we spend on R&D in the United States and how little actually comes out and applied in the real world. There are all sorts of barriers there. So really want to focus the Ann Arbor discussion on the challenges and barriers of commercializing deep tech and science tech.
Fair enough. Well, I think we got to transition in.
Yep, and I'm definitely hearing some themes here around the future of building things. You're thinking about companies and entrepreneurs, having the right team, having niche strategies, companies that are building things, disciplined valuations, and looking at things that are spaces around, everything from deep tech to defense, space, cybersecurity, things that are enhancing productivity. Some of those things I think people aren't thinking about enough, as well as materials. It's a great point that you just made, Mark. Stephen and Sean talk a lot about that, our ARS friends. So with that in mind, so given the market dynamics that we've outlined, why do you deserve to win, and how are you adjusting to the marketplace right now?
We're going to go down the line with Angela, Jay, and Hugh. Angela, do you want to kick that off, or do you want to play cleanup?
Do I want to kick it off? I'll play cleanup. Why not? Why not? I'll pass the mic on. Okay,
so Jay or Hugh.
Hey, Mark, are we making the transition to the next panel, or for?
Yes, we're on to the next panel. This panel's out of time.
Oh, okay. I didn't realize. Thanks.
Or I can kick it off. I'll make it easy, Mark. And then, because Anne did a nice segue into building blocks and the conversation. So I'll take the stab at starting it off for everybody, because I think it's a good segue. But great to hear everybody from the last panel and the conversations of where funds and angels and platforms are looking. Obviously, thanks Mark and 361 for the opportunity to present today. And my bio is there, so I don't really need to go into much of my background, but I'm a little different there, being that I'm from the north. So good old Canadian up here, just north of you guys and north of Anne. Good to see you here today. Thanks for moderating. I think it's fascinating, being somebody obviously as a tech founder and looking at where the markets are and listening to what Stephen Burke was saying prior to today's discussions on market trends. And obviously we've seen a shift in where it's at. And I kind of look at playing on both sides, obviously, as of right now, being somebody that's in the market, raising a seed round. It's definitely had its challenges, to say the least, but very, very optimistic, and being, I think, a forward thinker, and listening to what I believe it was, I'm looking at the names on the list, Hamiet, what he was saying in the last panel about, what's going to come out of this next trend, and that entrepreneurs and founders are still going to be strong, and things are still going to be there to grow. And that's what we have to look at. And it was notably like what Neil was talking about in 2008 in the last recession, where tech companies and innovation were still there. We still needed to deploy capital and invest in the future, because that is a part of, going back to Anne, what you were saying about building blocks. So I'm really excited, personally, just because made a very strategic and stealth decision, which was a very difficult decision in 2020. My tech company was ready to launch and go to market. We had a little bit of fuel in the bank. And, you know, it was a real big decision to pull back when we saw what we were going to market with completely shut down. And I think that's, you know, being a founder and putting that hat on, you have to make sometimes that decision. Now, I don't think anybody in this world knew that this pandemic was going to go on for 2+ years, and then that we were going to see a war break out in Russia and the Ukraine. Obviously, we could predict it, but I think we're all kind of still in shock of what it's doing globally. But being somebody who's kind of looking at that, it's interesting. I started to connect with some of the network, got introduced to 361 firm, and started to really learn about this incredible opportunity in the family offices and where you can put yourself out there as a founder and learn about where you can stage your, I guess, your next moves. What I really found powerful, and I just met with somebody that everybody should definitely take a chance to read his book, Sir Darren Jacklin. He wrote a book called Purpose, Perseverance, and Payoff. And that's what I'm going to end kind of my introduction on today, because I think that's where, you know, something that I want to pay forward to future founders, not just myself and my team, is that I think fundamentally, if we look at tech companies, or you look at all those markets, like what Safa was talking about, of where are we going to be seeing the investments moving forward from today and in the future, whether it be financial inclusivity, which is what my company is looking at, and healthcare and different models for education and outreach, but, you know, optimizing the small business sector. There's a lot of opportunity that come out of this. And I think that's where, for myself, I'm excited to look at where can we fundamentally plant that seed for purpose. And whenever you can persevere, fantastic. And at the end, there's that payoff. So, and I'm also excited that valuations have become more realistic. I was not a huge fan of some of these companies that came in the market, survived 12 months, and were already unicorns without knowing the cost to acquire a customer, and having what I would classify as really knowing what the revenue line is. And I'm excited to come in and be more realistic with those terms and develop a business that's going to grow and be strong in the market and hopefully last for quite some time. So that's kind of my take on where I think the future is. I think there's a lot of opportunities for founders in this space. And I think there's a lot to learn from working with great funds and angels and platforms that are out there to support the ecosystem. And I really do hope that more founders are tapping in and linking into great organizations to look for advice and mentorship, because the future is really about collaboration. And I think that's a different play than what I saw with my first company, you know, founded in the last recession in 2008, interesting enough, where it wasn't necessarily about collaboration. It was more about partnering and being very defensive on what your tech was and what you were doing or what your business was about. Whereas now it's more advancement on how can you work together and be a stronger push to market, and work with some great teams that are going to be there to plant the seed, help you grow and get to that next stage. And that's also a switch that I've seen in the funds. So
Terrific. That's awesome. Thank you, Angela. It's great seeing you as well.
yeah, thanks.
So Jay, would you like to weigh in with your point of view?
Sure. And from my experience, 18 startups, 6 exits, raised about $400 million from every type of conceivable investor. A very proud and grateful portfolio company of Neil Gupta's company, Kiwi Tech. I run reentry centers. We help the 1.2 million people who get out of jail every year, 80% of whom don't have a house or a job or a bank account. So our reentry centers are the facilities they live in. Reentry app helps the parole officers, help them, and then Reentry Pay provides them the first online bank account ever built for felons. So our this economy rewards 4 types of fluency in my 35 years of experience here. 4 types of fluency. Number 1, fluency in tech business models. That gives you the power and confidence to pivot. Remember, 2/3 of venture-backed companies needed to pivot at least once to get funded.
Yeah.
Number 1. Number 2, fluency among generations, which allows you to understand the past and future markets. Remember, the Fortune 500, when I graduated from UCLA, only 18% of those companies still exist.
Wow.
Number 3, fluency in math, especially financial math, which helps you raise money from everywhere and anywhere. Here's an astounding fact. Kleiner Perkins reported that only 15% of funded entrepreneurs know how to calculate dilution for the next round. That's just math.
Wow.
And number 4, fluency in spoken languages so you can understand our increasingly small world. And here's another astounding fact. Only 37% of Americans have a passport. That means that the rest, way over half, have never traveled.
Yeah.
So there you go. 4 types of fluency that are rewarded in this economy. And happy to take questions and pass it on to the next speaker so we can keep the flow going.
That's a great perspective, Jay. Obviously, you've earned a lot of experience with all of your launches and successful exits. Thanks for that. Hugh, how about you? Would you like to begin?
Thanks, Anne. Thanks, Mark. Also a Kiwi tech portfolio company. Thanks to Neil for inviting us to participate. I'll talk briefly about the business and then just some perspective on the market as we see it. So we are, I guess, in year 6.5 of LVH. We did a seed round back in 2018, and we are in the process of doing an A round right now. We started this process so mid part of Q1, and we have seen a pretty pronounced difference in the perspective we've got from investors as we've gone through the process. I'll touch on that. LVH is a ultra luxury home sharing platform, so we connect owners and guests of luxury homes, as I think Mark described us at the beginning, as Airbnb for billionaires. Certainly lots of our clients are not billionaires, but a significant percentage are. We sort of solve a problem for our guests. How do they avoid all the challenges of staying in a private home and getting a very high quality level of service consistent with what they might get in a private yacht or in a 6-star hotel. It turned out after the initial alarm that we did very well in COVID. People started to retravel, and the people that were able to travel again quickly were people with private jets and the time and the money to go anywhere, which they took full advantage of. And on the owner side, as people have alluded to, there's been a lot of activity in the real estate space. Valuations have gone up in the luxury real estate market dramatically. Owners have been keen to offer those homes, and you've seen an increased supply on that side. And for our homeowners, it's a very attractive proposition having somebody take on the burden of management and marketing these homes, generating money in some cases to cover their operating costs, in some cases to generate some small returns. Most people buying luxury homes are looking for long-term asset appreciation. And we fit very nicely in that. And for some owners, to the point of even turning these private residences into commercial assets and writing them off. As we head into, with a full recessionary environment or uncertainty, we actually think our business is going to do as well or better. People will be, high net worth individuals may put off purchasing another luxury home, but they're certainly not going to skimp on time with their personal time with their families. And on the ownership side, I think more owners will be open to this idea of generating income on the assets they already own. In terms of the perspectives on the investment climate, we've seen a pretty pronounced. So because of the stage we're at, we did around $20 million of gross revenue last year. So we're well past seed stage, but we're not quite at what a growth equity phase. So we've had a combination of conversations with some, institutional VC-like investors, as well as family offices. Because of the nature of our business, we actually know a bunch of family offices that are already clients, and the ones that know us are quite keen to dig into it in more detail. At least from my perspective, the ones that we're speaking to seem to have a longer term time horizon, particularly the closely controlled family offices, I assume because they're not answering to LPs. So if they understand the thesis of what we're doing, and they understand certainly the timeline, uncertainty over the next 12 to 18 months, I think long term, the businesses like ours will do very well. And understanding that timeline and really understanding what we have done. And in this regard, having a partner like Kiwi who really understands everything about what we're doing and to really vouch for how the business is being run is extremely helpful to us. The third thing that we're seeing is that we're talking to investors globally. I think people are talking about this movement out of the traditional investment centers. We have investors in several countries looking actively at the business. I think as people have started to move away from this idea of localized businesses, the same way companies have moved their workforce to be global, we are seeing the same thing on the investment front. And people saying, I can invest in this business We happen to be based in New York, or at least I am, though we have a global team, and we're seeing that people are very comfortable investing outside of the geographic location where they currently live.
Mhm.
I'll turn it back to you, Ann.
Terrific. That's great. So thinking about the market that we're living in right now and the dynamics that are ever changing, in your thesis, tell me why you deserve, each of you, why you deserve to win, and what adjustments are you making to handle the dynamic environment that we're in right now?
I'll take that, Ann.
Okay.
So reentry centers will win because nobody else is doing this. My dad had a saying, God rest his soul, that if you learn how to do things that nobody else wants to do, you'll always have a job. And so nobody wants to help prisoners. Nobody wants to help felons coming out of jail. We're doing the heavy lifting there. It's very rewarding. It's also very challenging. Folks have a bunch of challenges coming out of prison, but we'll win for 3 reasons. One, we'll win because we can raise all sorts of money from a lot of different places. And this is a time for real financial fluency, because there's more money out there from more places than ever before. It's not just safe notes and priced equity rounds anymore. It's non-dilutive equity. It's royalty financing. It's venture debt. It's, you've got all flavors of money. So knowing how to raise it, having access to it is fantastic. Number 2 is we've got great technology that actually solves and allows us to scale into this marketplace. And 3, we've got a tremendous team that knows how to address this marketplace. Your team has to be adjusted to the marketplace, has to be adapted to the marketplace, and our team is really focused on this. In fact, by the time we hit Christmas this year, arguably 94% of our staff will be felons.
Wow.
And we'll probably, by the time we reach 1,000 employees, which will be about 2025, we'll have the largest percentage of felons as in our workforce of any company that has ever been funded by venture capital.
Wow.
I just want to do a bit of pointing out that we've been focusing on this issue, Jay, and we've been looking for impact investments. This is Eric. Oh gosh, why am I blanking on Eric's last name? Help me out, guys. Lindbergh.
Yeah.
Runs his parents co-founded the Bengals, and since and he's been giving grants, and so we're doing it on the philanthropic side, but we've been looking for impact investments, and we've thanks to Kiwi Tech, we've met you. So I'll
marvelous. Happy to have more conversation about that. Our cap table is probably the most target-rich environment for private equity or venture capital that you've ever seen in the history of mankind. So
that's a big statement.
That's bold. That's bold.
We actually attack hyperbole here, but we'll allow it for now, because I hope you are what you say. So
yeah, it's a very nice opportunity. Thank you for raising your hand on this impact. So, and that brings up just one other topic, and on impact. It used to be back in the Sarbanes-Oxley days that ESG investing, impact investing was a separate thing. Corporate responsibility was a separate thing. I used to publish a magazine that published the 100 best corporate citizens list called Business Ethics Magazine, Business Ethics, and then became Corporate Responsibility Magazine. And that was a separate thing. Now, impact ESG has to be baked into your model. It is not just a separate thing, separate checkbox. It has to be built into your model. Fortunately, in the case of reentrycenters.com, it is our model, but it really has to be built into everyone, whether you're in the energy business or the real estate business or technology.
That goes to one of your portfolio companies, Dan, who's trying to make it a lot of our and actually maybe that's over to you, Angela. Maybe you segue to you what you're doing with Web 3.0 and with mission-based alignment.
Yeah, no, absolutely. This is Jay. Absolutely fantastic. I've checked out everybody's organizations and what you're definitely up to. Lots of alignment. So we'll have to connect after this. But, I think I'll go back to what I last said, was that purpose, perseverance, and payoff. 3 reasons. I'm excited, but personally, when I look at, and if it was like taking it from a scale of what is out there in the markets right now and what I feel founders should be looking at, one of the major things that I look at is innovation, technology, expansion of how we can do that, but more so what you can build for your life team, who you're collaborating with, your communities that you belong to, because that's going to really drive you into what you can offer. And then really our focus, similar in alignment, Jay, and definitely for us, it's looking at that inclusivity market, right? Tap and Go, I'm really proud to say, being the first female founder of a neobank here in Canada, set to launch shortly. We've really pride ourselves on looking at where we're going with the metaverse and the Web 3.0 on being there for open banking and being better banking tools. So I come from a family that's all educators and farmers in their background, and I really look at what we can do to better the people. And I think, if we take a step back in the sense of what has driven business in the past, and we look at the small business owner on a global scale, not just a domestic or an international scale, it really has global reach, more than just saying international. I think there's planting that seed and fostering what we can do to innovate technology to drive better services. So we're ready to go and do something that is very unique with our lined up MSP partners, with our bank sponsors, with our processors. And I really pride myself of being able to align with those that are people of determination on staff, the female founders, the LGBTQ. I think there's so much more that we can do. I know the stat recently just came out from Payments Canada that in Canada, we only have 5% of female-led CEOs in the tech sector. That is a very small number, and I would like to change that. And I know that that number is very similar in the United States and globally. So we have a long way to go. But I do feel that there's a lot that can be done, and being purpose-driven. I think, Mark, to comment on the impact investing and the philanthropy side, that's the other part that I would like to add to that piece. People at the end of the day, it doesn't matter whether you're a business owner or a person, we are all driven by what gets us out of bed. And I feel if you're a business owner or you're an entrepreneur or founder, if you can find a reason for connecting to an audience or community that cares about what you're offering is, whether it's a product or service, you have the ability to grow and be strong. And that's what we need to do as we start to foster those relationships where we can do better and be more inclusive of others. So.
Perfect.
Angela, that theme touches on what was mentioned in the last panel as well, which is, building things, building products, and you're just saying building products that people care about, which I think is an added dimension of that that's really important.
Mm-hmm.
Do you want to speak, Hugh, to your right to win or mission-based alignment? Or
yeah, with pleasure, Mark. Yeah, so I think for us, it really probably comes down to four things I would think about. Number one, and it's probably true for a lot of companies at our stage, there is a clear need for our service. It's not an app looking for a purpose. We solve a real business problem. We have lots of validation points, client happy, referenceable customers who will talk enthusiastically about what we do and the value we've created for them, which is a great reference point long term. Two, a message that resonates with new clients very effectively. It's always hard to get through the noise, and if you're going to grow your customer base, no matter how you do it, you've got to be able to deliver something. I had the experience of being introduced to an individual, literally one of the wealthiest families in the world. After hearing what we did and how we did it, they described, her response was, "Hallelujah, I found you guys." So I've done a lot of business development in my day, and I've not heard that type of response very often. So I think that's important. Three, an amazing team. We had very much a near-death experience in the middle of COVID. We had many moms with no revenue, just refunds, and it was very challenging. It was what comes ahead now with this market uncertainty, to me, is far less impactful for a business than that was. If no one could travel anywhere, of course, we're not going to do anything. And we had clients who were canceling and taking advantage of force majeure clauses that were built in the pre-COVID era. That mean we had to refund them all their funds, and it was very difficult. And so we struggled. We took the opportunity in the middle of COVID to really move to a global-based team. It has been fantastic, and that team, I think, will power us through to the next level of growth. And then the last point, I think, would just be persistence. I think, our clients appreciate our persistence. I think investors understand at the end of the day, the right team will figure out how to get it done. And where that requires a pivot or readjustment, we haven't made any major adjustments yet, Mark, in terms of the business model. We're looking at some opportunities to offer some additional service to our current clients that will be accretive to margins. We are being cautious about hiring in this environment and trying to do more with less, but we're still on the broadly the same path.
That's great. Well, we're gonna before we transition to breakouts, we'll definitely be interactive. Any we always like at least some question from the audience for what you heard. Don't be shy. Again,
Well, I definitely heard a theme, Mark, that's worth noting, that, having a business or being in a business where you're solving a real problem that resonates. And, Angela, Hugh, Jay, all mentioned that as important.
well, partly to that point, I just want to, before some people break and don't come back, in healthcare, and that's solving lots of problems, obviously, from some of the companies that are in deep tech or really interesting blood testing, like full suite testing, mobile, real time, which is where medicine's going, and other longer term things that to solve or help treat diseases on the biotech side. And then, since we're talking venture, is this Israel ecosystem, and I like to create more of an access for Israel to Cincinnati, and we could
Okay.
make that work. But so what we're going to do is set up rooms for but Jennifer, wait, I put her out to play the ultimate cleanup. Have I my screen here? There you are. Jennifer, could you you've heard this. I look at this, the way to play secondary is an interesting way to play this venture market. And we've played it a couple of times with some groups here. But where is Jennifer? Jennifer Liu. Maybe she may have stepped away. But I will say this, I think secondaries is a tough one if you're in the general space. Obviously, we thought with COVID, the secondary markets were going to rip open because of lack of liquidity. And then the Fed came to the rescue. Now, I think it's an interesting dynamic. It's too bad Jennifer's not able to join, but we do have a breakout for secondaries. Anessa, do you want to kick off these breakouts? And then what we're going to do is in the breakouts, I'll swim around. There'll be a general room for just carry on the venture discussion. There'll be a room for secondaries, and each of the speakers will have a room. Speakers can choose to do that or stay in the general rooms. And then if you're not ever sure, stay right here and we'll move you around. So we're like your conductor, so to speak.
Mike, how long will we have in the breakout rooms?
20, you see that about 25 minutes, and then we sort of come back and we like, at least with the two group breakout rooms, we let them just sort of share what they've learned, some takeaways back here in the town hall.
Okay, because I have to unfortunately leave in about half an hour. I'll stay for the breakout room, but maybe someone else.
You're in good shape. We'll be back in 20 minutes, I guess, more like.
Okay.
So that said, Anessa, you want to kick it off? You have the ability to move around your rooms. If you're on an iPad, you push a button. If you're on a Mac or a computer, you can you find your 4 little dots or whatever and move it from there. Or Anessa, do I have to do it?
Mark, are you going to say what the breakouts are?
Yeah, you'll see they're all, there's a room, 2 main rooms, one's for early venture, one's for secondaries.
Okay,
And then there's a room for everybody. So if you go to, I can assign you. And I think Anessa, you have the room set up. Do you all see it? I could,
I don't see it yet.
Should we be going to the individual rooms or to the early VC secondary rooms?
you go to wherever you wish, but if you want to have a dedicated, like I see Hamlet has a couple people there now. You, Jay, Angela, Neil, even you, Ann, but then I would suggest you stick to early VC.
Yep.
Hey, Mark.
Be interesting, and I'd be happy to make an introduction.
Transitioning out of this other one.
Yep.
How's William Dahl for you guys?
Sorry to interrupt, and I need to just.
Good. And a quick chat about primarily, it seems like his big care is about energy and clean tech, which definitely does have a national security component to it.
I want to fold this one and bring everybody.
Sure.
And bear with me, I just want to turn my AC on. I got everything shut down because of the light. Bear with me one second.
Yeah.
So to maybe Hamlet or Peter, you just what did you guys focus on in your rooms? I assume cyber and defense.
Yeah, I think we just went a little bit deeper in terms of what it means, what defense tech investing means. When we say defense tech investing, some people will shirk because they automatically assume like guns and bullets and tanks and stuff like that, and that's not what we do. We actually purposely do not invest in weapon systems. We invest in deep tech that enhances national security and defense, but more importantly, has a dual use component, meaning it has much greater utility in the private sector. So cybersecurity, offensive, defensive, autonomous systems, robotics, AI, data analytics, commercial space related technologies. Those are all areas that impact national security and defense, but have a much greater application and potential in the greater civilian economy. So I think just getting a little deeper into that thesis is what we spent some time on.
I got a company you might want to talk to, Hamlet.
Sure.
Funded by the U.S. Air Force. It's a chemical detection device. I don't know if you do devices, but it's yeah.
Look, we're always happy to take a look at companies. What we do is we'll usually quarterback if it's not of interest for us. I'll probably have a pretty good idea of who to show it to. So if they're looking for work in that space, and they're looking for allocators who want to allocate, or they're looking for funding, yeah, I by all means send them my way.
Sure thing.
And we've talked about doing a defense space deep dive.
Yeah.
Peter, good news is, I was gonna say Peter Bergen's on, and he has skills. He has skills I didn't realize he had. Moderating, doing takeaway.
Don't believe it, everybody. Don't believe it. Okay, he's just trying to get some assistance here. Okay?
I can second this. He's actually a great rap man. He's really good at pulling it all together. It's formidable.
All in favor? Aye. Ayes have it. You got it, Peter.
Oh, wrong. Wait, it's Tuesday after a long
Did you
weekend.
know he has dancing skills?
We're really not going there. Truly not going there.
Okay,
But
well,
thank
we
you
are
at any rate.
having a fintech event. Angela, just to take note, now there's Dan Hupsher, who's a relatively new banker. He is a little on the crypto side, but not only overlapping blockchain, DeFi, and some other parts. So, and quants, he's a techie himself, and then some others. So we'll be having a whole slew of series of fintech, and a fintech, basically a summit in New York as part of our October event.
That's great. Is it going to be the one that's the early October or the latter?
Well, early October is Michigan.
Yeah.
Mid-October.
And late October is the New York one. Okay.
And in fact, we're tying Toronto to the Michigan one. Let's see.
Okay. Well, definitely we can connect on that. Hopefully, fingers crossed, Tap and Go is actually present. It's our Canadian Thanksgiving usually that weekend, but it's also the first time the Ironman World Championships will return to Kona, and Andrew Mesnick and his team are waiting to hear if we're going to be implementing our technology into their wallet for participants across that. So I'm hopeful to actually not be present in early October and to be in Hawaii with my company. That's the goal right now, but the latter part of October would work.
All right, well, a lot of bites of the apple. We'll take it when you get them.
Exactly. Perfect.
On the other breakout, we talked a lot about shrimp. Thanks to Andrew Voss and others, and Brendan and yada yada. It's well, any other takeaways that you came out of that end? You're on mute though.
Ours or the other?
Let's switch to Ann real quick. We'll go back.
I don't know that I.
How about who was Joe? Who was Joe? I didn't hear his story. Joe Milan from Texas, or to get it right? Tino, do you know him?
Yeah, I do know him. So he's a former buy side institutional investor, and he used to work at the CSFB and was created this whole how do I call it, reporting mechanism that shows the likelihood of success of a privately held company, similar to the DuPont ratios, but using different metrics. And so he's building early stage private equity type of platform.
A platform dashboard.
Yeah, exactly. And so as a service, as to seed his community, he also runs an investor relations service that helps early stage founders communicate out to their stakeholder groups.
Okay.
I mean, he's got a long institutional investment background, and now he's applying it to private, portfolio theory to private.
Okay, fair enough. Any other takeaways?
Nzumi mentioned the panic that he's seeing with his entrepreneurs that he's working with in London. That seems a little bit consistent with what we're hearing on the coast that was mentioned in the earlier breakouts, that Hamlet brought up, Mark mentioned as well, SAFA, definitely. As he mentioned, the cost of capital, cost of labor, regulatory increases, increasing inflation. That's obviously there's a swirl of, for all of us as investors, allocators, and entrepreneurs to navigate.
True. I did hear from Bill Deukler that municipal pensions are have been opening up to private equity venture in the last couple of years.
Yeah.
Because I know we as a group haven't focused as much on them as allocators.
Another thing that Hugh mentioned was a wiggle or pivot that they made relative to the team during COVID when they almost were left for dead, and they moved to a global team. So they have a very large team in Croatia that gives them a 3-to-1 cost advantage on the employees, in addition to having back offices, in India and other places that might be normal for people.
So what did you think, Neil, for a while when there was zero revenues coming in?
Well, interestingly, that was actually an opportunity for our investors to come in at a really deep discounted valuation. I think we raised something like a $5 million valuation or something ridiculous for such a quality company. So we did a bridge round for them. And, they took some dilution, but they stayed afloat. And, the investors were up 5x in, I think, a year, or less than a year. And now they're up probably about 12x,
We're talking to them tomorrow about, we're looking for a yacht.
Yeah.
And some interesting, we have housing, but we have hotels and other spaces, but it's either suboptimal or too expensive, but we'll see what they can.
They got a lot of good inventory. I mean, 3,000 properties, including yachts and jets. So
they may be our partner around the world if things go well.
Oh yeah. They got houses everywhere. I mean, London, houses and condos, Beijing, obviously New York.
And Jay's company was, as everybody knows, we've been trying to focus on the prison population. So that was great.
Yes, very relevant.
Able to help you out breakout sessions, but not with yachts, Mark. Okay, that's where I draw the line. Sorry to interrupt you.
Well, yeah, no, there's going to be there's the cyber yacht. There's the angel investing yacht.
It's not compatible unless it's something real esoteric, and I'm not going to be afraid of that. All right, it's just not out of my domain. So
you can stay on shore. It's okay.
that could work. That could work. We can
get your sea legs
about that plan. Yeah. Sorry, continue. I couldn't let you go get away with that. We need a yacht.
But anytime I start playing ABBA or particularly Dancing Queen, you're my guy.
Okay, you're going to start to get me to stop providing input. Okay, that's what's going to happen here. Okay, every time I chirp, and I'm trying to provide, some kind of basis of reasoning here, I get caught up with the same thing. We got to change that up.
All right. You can penalize me every time I think.
Poor Anne's trying to keep her laughter from, being. Yeah, I can. Never mind, Anne. We'll touch base later.
Anne was up there. She was going at it too.
Oh,
I was. Hey,
it was broad participation. I just happened to get the most of the attention.
It was a dance off. The students couldn't stop talking about
Team
it.
Player.
I got a really nice note from one of your students that was like a pivotal event for him.
Really?
Yeah.
Which one?
One of the founders of Ripple.
Joe or Zach?
Zach.
Yeah, that's great. He's coming over to my house tonight. I've got about 8 or 9 students coming over to do a pop-up grill out.
That's nice.
Mark, did WDB help with your music research over the years?
No, I was rejected as a DJ. So I went over the fine arts. I became the fine arts editor so I could do my reviews of albums back in the day.
You're looking at one of the old DJs when it was a 10-watt station.
Nice.
Granville, Ohio, Licking County rocks.
The doobie.
You got it.
Oh, that's awesome. Andrew, I grew up in New Lexington, Ohio, just south of.
Neil grew up in Ohio too.
Marietta.
That's right. That's where my grandparents, where my great grandparents grew up.
Yeah.
Tino's cut his teeth in Cleveland. So.
Well, I'm old enough that we played the first CD on the radio station, transitioning from vinyl. 87.
That's awesome.
It was actually ranked one of the top college radio stations in the nation, I think next to UCLA for a long time.
Wow. Denison continues to demonstrate surprising excellence.
Yeah, they have another
place.
We can keep. I don't want to keep going on Denison.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.